We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is John Williams, founder of shadowstats.com. John, it's a great pleasure to have you on the show.
Tom, thank you so much for having me.
So, John, you received your economics training from Dartmouth College in 1971. What was it about these statistics that made you really want to start paying attention to it in this way?
Well, that came on to the Tuck Business School after the undergraduate, and I got into econometric modeling there, where you can take existing numbers and put them together mathematically and try and work out the relationship with other numbers and forecast with them. And so find you've got numbers here that have a leading relationship to numbers, let's say 3 months down the road, and you can work out that relationship. You get the numbers in January, and you can give some estimate as to where March is going to be with a degree of accuracy. Mm-hmm. I became somewhat enamored of the concept. I was in a family business for a while, sold that, and I started my own economic firm, forecasting along the lines of trying to estimate what was going to be happening in the near term. I became not only a student of I became a student of the government's statistics, and as I went back and looked at them and tried to look at what was good for forecasting, what wasn't, and trying to make sense of what was being reported, I found there's a tremendous amount of variability and tremendously large revisions. Mm-hmm. And in fact, there actually was, and I saw it, some political manipulation. Again, this is back in the 70s and 80s. There are things like that still happen, but you get around it with some numbers, older numbers, if you can see where that's been manipulated, you can adjust for that and come out with an estimate of what it would be without the gimmicks. Mm-hmm. As an example, just the type of thing that used to happen and still does, but a little more creatively. When I was first looking at this, one of the important numbers is employment growth. Mm-hmm. And every year, payroll employment, which is a number, would get revised downward, and usually fairly meaningfully. That is the number for the past year, as it had been reported. And then back in the days that I was looking at that, you could still go see the people in Washington who handled it. I asked the guy who prepared him, I said, why is it we always get a downside benchmark revision to the payrolls? He said, well, if we got an upside revision to the payrolls, I'd lose my job. And very, very simply, that would have meant that he had understated the payroll growth. And that's a very big number politically. So that you'd have to look at those numbers very cautiously, and over the years, that concept has changed. And in this last benchmark revision to numbers back in January, the Bureau of Labor Statistics said simply, the numbers we're publishing today are no longer consistent with the numbers previously published. So you look at that, and those numbers are not meaningfully in comparison, but they're still reasonably close, and they're still looked at on a year-over-year basis. And I don't care what series you're looking at now, other than the gross domestic product. What you're seeing is generally a slowing in the economy and some mounting inflation pressures. That's somewhat contrary to the happy hype out of Washington, but it's an uncomfortable reality. And so that's what I write about. I try to quantify the estimates and put at least a heads up here. This number's likely overstated or understated, and here's my estimate of what it is.
Mm-hmm. Well, I would like to dig into many of the topics that you mentioned there, John. But, you cover a wide range of different metrics on your site. One interesting example I came across was your work for a large manufacturer of commercial airplanes who had developed an economic model for predicting revenue passenger miles. So the level of revenue passenger miles was their primary sales forecasting tool. And the model was heavily dependent on GNP, now GDP, as reported by the Department of Commerce. So suddenly their model stopped working and they asked you if you could fix it. What is your best explanation for why the quality of government statistics has deteriorated sharply in the last couple of decades?
Well, it goes both ways. You have more complete and, from that standpoint, accurate surveying. But the primary reason for the decline in quality is redefinition, where there's no consistency going forward. I'm not an accountant, but I have worked as an accountant, and anyone who's familiar with accounting is familiar with the term generally accepted accounting principles, GAAP. And that is those are the principles by which you assess the numbers. There is no such a thing for the government's numbers. If this was being prepared using accounting rules, if you made a change in definition, you'd not only describe the redefinition, but you'd work to report the number on an ongoing basis in terms of on a consistent basis. Mm-hmm. What the government does is that although it will describe the changes, it just goes on with the next system, which usually is an improvement. In fact, if you look at the consumer price index, which is a prime example, in fact, got me really going on looking at key numbers and where they were being altered. The consumer price index, which is used in slightly different versions for cost of living adjustment on Social Security, for example, or something that's often used in commercial contracts for year-to-year cost changes. Up through 1982, 1983, the definitional and reporting changes, definitional numbers were all basically the same thing. But occasionally you'd have a change in a series, but you didn't have definitional changes as to how they were calculating the CPI. What happened was in 1980, you had a very strong inflation number due to the I forget the exact item that caused it, but the net effect was that the way the cost of living adjustment was set for Social Security, it meant that Social Security would get the Social Security payments would get a big bump upwards in the next year. And the people in Congress realized that meant they weren't going to have as big a deficit they could get away with. To correct that politically awkward situation, they decided to redefine the consumer price index, and they held hearings with a committee headed by Newt Gingrich at the time, and Catherine Abraham, who was then the head of the Bureau of Labor Statistics, which publishes the consumer price index, wrote in her memoirs, and I'm paraphrasing here, that Chairman Greenspan made the point that if they could only find a way to redefine the CPI this way, then they showed them how they'd like it to be, or at least what they were looking for, that they might be able to find more money for the Bureau of Labor Statistics. Mm-hmm. And there was a major change made to the way the cost of living adjustment was calculated. One of the biggest components of the consumer price index is housing. It used to be what you own, the cost of owning a home, or at least that used to be a category. That was redefined as homeowner's equivalent rent. Right. What a homeowner would pay himself to rent his own house to himself. And that one change back then knocked 1.5 percentage points off the headline CPI and reduced cost of living adjustments going forward. It was the changes have gone. There have been a number of changes since, and again, the Bureau of Labor Statistics is forthright about the changes. They say, here we're changing this, and the effect we believe it will have on the numbers is this. And in each case, in the CPI, which has been continuously, although with different timings, redefined since the early 80s, they've always published, okay, here's what we're doing, here's what we estimate the impact is going to be. All I've done is I've added back in their estimates as the way it would have been had they not made the changes. And right now, if you look at the latest headline CPI, which was for April, the monthly year-to-year change was 3.4%. Adding in all the changes by the Congress, or the Bureau of Labor Statistics, as allowed by Congress, since that 1980, the first change, the differential now is 11.2%. It's 11.2% higher than it would have been had they never put it in. So those changes have added somewhat shy of 8 percentage points to the CPI that are not consistent with the way the series used to be defined. And that's very significant.
And is that still month over month change, Sean?
That's year-to-year change.
Okay.
Year-to-year change. In other words, if you look at the April CPI unadjusted, not seasonally adjusted, for April 2024, which is just reported, the government, it's came in at year over year. I'm saying that if they had not made the changes since they went into this redefinitional mode, it'd be up at 11.2% year over year. That'd be the current CPI inflation rate. And if you're getting a salary adjustment on that, cost of living adjustment, you're being cheated out of something over, or let's say 2.5% per year.
So, John, is it understandable, in some ways that this calculation should change over time, considering our economy and what people spend money on has changed since this metric was created?
You do have the actual way the system was handled was it reflected that. It wasn't just a set number that went through and priced out all sorts of goods, and the goods were weighted by whatever was transparent. So you had an actual cost of living on average across the board. What was changed here was the pricing of that, and the aggregate change in the pricing is based on the aggregate change on the CPI. I'm using what they report in terms of the CPI, and that is weighted for whatever the consumer goods distribution or services is or was at whatever times involved here. So that when I say there's a headline year over year 3.4% for April, that is 11.2 with all the changes. So that's 0.2% shy of an 8% differential that's aggregated over what is now, I guess, 40 plus years. I mean, it's not all up front, but that's aggregate over that time frame.
It's funny when we think about, some of these metrics, kind of going back to that idea of, GDP or housing or any of these metrics that are adjusted for inflation. If we're using the wrong number to adjust for inflation, you get a completely different outlook on a lot of these systems, a lot of these metrics, and a lot of the downstream effects, don't you?
Yes, you do. Let me put it this way. There are some advantages to the government and the Fed to having understated inflation, using understated inflation. I mean, in terms of cost of living adjustment, that's what you see with the CPI. But when you look at an economic number, usually it's reported in nominal terms, which is the way it's priced out in today's dollars, what people pay out of pocket for it. And when the way the economists look at it to see how the economy is going, they adjust that for the effects of inflation, because if inflation is there, the dollar price shows higher growth. You back out the inflation number and the effect over time, they use the CPI index. It used to be, and it's why the reason you had the cost of living adjustment structured that way. That was just the cost of what was the inflation going forward from, let's say, 1982 when they changed it, the difference as to what the headline cost of living would rise by versus what it now rises by after the various redefinitions that took place after that. The higher inflation shows that you're generally worse off, and the shows that you're better off, that you're buying things more cheaply, which it's a reverse of reality. But they haven't done too much recently until the pandemic came along. I say they haven't done too much. The Bureau of Labor Statistics, when it makes a change here, it will publish a paper on it, and they'll say, here's what we're changing, and here's what we estimate the cost of the effect will be on the headline CPI. And again, it's their estimate that I use to back out as to what it would be without their change. They haven't published anything on the pandemic period yet. And it'll be interesting to see how they work that, because what they did that was different. And again, you want to look at consistent numbers over time if you want to have a real sense of how you're doing. When the pandemic hit and the economy plunged and inflation soared, they shifted to reporting the inflation with an impact affecting the numbers of using a three-year moving average, which obviously was below what you'd seen before the pandemic. And then as the pandemic switched over, and things started to come back closer to reality, and the headline inflation rate came down, they left the moving average in place, but they shifted that to 2 years, which was a weaker, actually more of a negative impact on the headline inflation. So even with the extreme inflation numbers seen in the pandemic period, and I've not made an estimate at recalculating them, I'm going to wait I'll accept what the Bureau of Labor Statistics will put out when they finally report it as to what it would have been. And there's no argument. The headline inflation will have been higher than I'm estimating because of the distortions that were otherwise accounted for or adjusted for in the government's reporting.
So, John, what are some of the other downstream effects of changing this CPI reporting? Are there inflation-based adjustments that change, let's say, pension payouts, things of that nature?
Yeah. Well, it's the pension structures are somewhat like the Social Security adjustments. The effect here is that where the numbers usually are based on the current CPI numbers and then the aggregate change from whatever point in time, since 1983, the headline CPI has been understated from what it would have been had the same reporting methodologies been in place from 1983 on. The difference there has been increased over time, and it's never really gone back the other way. I mean, occasionally get a little fluttered, but we have a jump there that is still being worked through for the post-pandemic period. So the fact is that over time, or since early 1980s, the government's adjustments for inflation, and that's payments, at least in terms of Social Security, which is supposed to protect the retired people on Social Security to maintain their income levels for the same purchasing power. It hasn't done its job because the purchasing power of the dollars they've been getting have been reduced by the artificial depression of the headline CP used in the mandated calculations.
Mm-hmm. I think it's interesting to see, how many of these numbers are released and then revised after they're released. So what is the point of, really releasing the original data if they have the ability to just revise it down or up after?
You generally don't get that with the inflation because of, at least with the CPI, mm-hmm. because that is used not only with the government adjustment for inflation in payments, but also it's commonly used in the private sector. They just don't revise it, mm-hmm. except for these redefinitions that have improved the quality of reporting, so to speak. And it's I've seen very few private entities that have adjusted, where they've been adjusting, let's say, pensions or such for the CPI to adjust for these changes. It's, from my standpoint, the way I view that, it's criminal. I mean, again, these people were, whether they were a private agency, and I'm talking now the government reporting of the CPI and put the political structure behind that, they would be in jail for accounting fraud if you had such a thing at that level. Because mm-hmm. People are not getting an honest deal. Now, an interesting thing just happened. I've been talking about this for a long time, pretty much since it started and going. Again, the effect here is that it overstates the understatement of the inflation, overstates the real meaning inflation adjusted, the real inflation growth of areas that are denominated in inflation adjusted dollars, such as pensions. Another one's the gross domestic product. Now, the gross domestic product is the broadest measure of the U.S. economy. There you have the numbers there are all estimated in current dollars, what you see out in the marketplace. And then each of those areas is adjusted for an inflation, an implicit price deflator that the Bureau of Economic Analysis puts together. Not necessarily, the numbers are not quite the same as you see with the CPI, because you're looking at different things. You're looking here, basically at products and services, but from a different angle than what the consumer per se is paying. You're looking at what's actually being produced. And that in parallel with the CPI, the implicit price deflator, the inflation used to deflate the gross domestic product, has been heavily understated. And as a result, the headline GDP, the real GDP they call it, real meaning inflation adjusted, which has been more positive, has not been at all. I'll contend we've been in a something close to a recession, albeit pandemic related, since the pandemic hit early in 2020. This is beginning to surface in some other numbers, and it looks like it maybe will be proving my point in terms of what's been happening here. We'll see what happens. The National Bureau of Economic Research is the defining authority of the U.S. business cycle, the gross domestic product, in terms of calling whether or not we've had a recession or we haven't had a recession. It's an independent private entity, and they do a lot of top economists. They do a lot of independent research, and what they did was they called an end to the recession, the pandemic recession, back a year or two. I forget the exact timing, and I don't have it right in front of me. But that marked the end. And in fact, the pandemic recession lasted all of 2 quarters, which was right back when the pandemic hit. And then you start to see, you see if you plot the year-to-year change, it starts jumping after those first 2 quarters and it took its big hit, and then it recovers its level, and you're off and running again. You have to recover the prior level really to have been recovered. What they're finding is that there's some other very reliable and independent indicators that are not suggesting or not confirming what was seen in the headline GDP, very specifically consumer sentiment, which is surveyed every month by the University of Michigan. And over the years, and they've published this going back into the 1950s, it has been probably the best coincident indicator that you can find of actual broad economic activity, and specifically the GDP. But where the GDP collapsed in the early pandemic, it then rebounded and is booming now. But you don't see that in the consumer sentiment. And this is a very unusual circumstance, as at least the National Bureau of Economic Research would look at it, that we have an economic recovery in the GDP, but the consumer sentiment has not recovered. Although consumer confidence, which that's a happy number that'll go along with whatever's happening with the government's numbers, is not based on a consistent definition over time, or one that isn't moving along with what you're trying to forecast when you gimmick it. The consumer confidence number will tend to move with the reported GDP. The consumer sentiment has nothing to do with the reported GDP. It's with how people are actually experiencing inflation and their own personal economics. And where that hadn't recovered, and usually would with an economic recovery, they looked into why isn't consumer sentiment rebounding with the GDP or consumer confidence. And what they found was that and this is a tentative, they've got it out for comment and all sorts of things. But I find it interesting that what they found was that you go back to the redefinition of the consumer price index that started back in the 1980s, and certain things like the cost of closing on a house disappeared from the consumer price index. And the effect there is that if you look at the headline numbers coming forward, where you start booming again with headline GDP, and where the sentiment numbers start falling off or don't recover. I mean, they're still 30% shy of hitting their pre-pandemic peak. The things that affect the sentiment include actual cost, including cost of buying a house. But if it doesn't, like buying the house doesn't include the closing costs, it's more expensive than if you count that. I mean, if you don't, it's more expensive than if you don't count that. And as a result, the sentiment, consumer sentiment, is more reflective of what they would be experiencing had the consumer price index held on a consistent basis, or if it was being reported on a consistent basis, which it isn't. So I think when this is all works out, that you're going to find that there's some question of what the effect of that inflation adjustment did to things, including the GDP. That's you can't have all those things working in the same direction and be getting accurate numbers. And now they're not getting the accurate numbers with what is still a very severe economic downturn, as suggested by the consumer sentiment.
Well, it's interesting that we kind of end up talking about this idea of redefinitions. It seems to be kind of a norm now of our reality at this point. I remember when they changed the definition of the money supply, right? Stopped reporting certain measures of it, or even the example of changing the definition of recession. So what are some of the most dramatic examples of this redefinition that stick out in your mind?
Well, when they redefined it, they didn't tell you everything they were redefining. It just came out as an aggregate number, or at least not to the level of the detail that I got into. To the extent the closing costs on a house were redefined, I was not aware that was a specific item that had been so changed, because there were changes there that. I'm sorry, my memory's drawing a blank right there.
Not a problem, John. But maybe we can take that example of understanding the redefinition of recession. It seems like this is only a one-way street to, not acknowledge the actual severity of the situation we're facing.
Well, you do have the GDP estimated, the gross domestic product, and that's usually the measure that's looked at to see whether or not you have a recession. You have all sorts of monthly numbers, like you have the Census Bureau reporting retail sales. You have the Federal Reserve Board reporting industrial production. You have the housing starts numbers. I believe that's also out of the census. But each of those the numbers are coming out of a particular industry, people who have hard numbers. And if you look at the monthly numbers as they're being reported, and adjust for the headline inflation, I'm not talking about the inflation the actual inflation that would make the real growth look worse, but just using the headline inflation with it, you'll find right now that the key indicators such as retail sales, industrial production, which is all the Fed does all the inflation adjustments on that. That's not a dollar amount. That's an index level. The housing numbers are out of the government, and there are all sorts of funny things that happen with the housing numbers are not particularly accurate. But again, the numbers there are published by the government. If you adjust for the CPI and the ones that are, or you need another type of deflator, but for the CPI for the consumer related items, which are the dominant element of the economy, year-to-year growth right now is flat at best. You just had we say industrial production right now is flat to minus. You have two components. You have the manufacturing, which is down, and then you have mining, which is basically dominated by oil production at this point in time, that's one area that's been gaining because of the higher oil prices and the games that the administration played with the Strategic Petroleum Reserve. But even there with industrial production, year over year, you're not seeing any growth. But if you look at the gross domestic product, which encompasses the entire economy and those very big elements, it's up 3% year over year. And that is largely due to artificially low inflation in the implicit price deflator that is applied to those things, and that's to the different components. And that in turn is also related to elements that are in the CPI. They're different elements, different components, but the concept is the same.
So, John, as you're mentioning the GDP, is that inflation adjusted, or is it possible that, when
what I consider more realistic monthly numbers that are also adjusted for inflation, such as industrial production, retail sales, and even the housing numbers that are so volatile, that are basically flat year over year net of inflation. There's a dichotomy there that's not easily explained away, other than well, those subsidiary numbers are wrong, or there's something screwy in the GDP, if you'll pardon the language.
Mm-hmm.
And the GDP is indeed the problem, or at least the way it is deflated. It's probably the biggest political number because it's used very frequently in defining or at least calling a boom or a bust, and it hasn't shown. It did show. Let me back off here. If you go back to the first half of 2023, the GDP was flat year over year and looked like it was heading into to what was going to be a recession that was already evident in other numbers. And then all of a sudden, it surged year over year. What happened there, which was a direct action by the administration, that did help the economy, at least short term, and it helped the headline inflation short term. It was the opening up of the Strategic Petroleum Reserve, which helped to bring down gasoline prices and brought the petroleum that's taken out of the reserve also was exported from the United States to other countries. Well, by exporting that's a plus to the GDP because the GDP reflects the net exports, and that where you usually have a deficit there, you had some plus because of the liquidation and export of this oil that had already been booked into the GDP. A very clever working of the numbers, but because you did have an actual decline in gasoline prices, you also had a very strong political gain for the administration. That worked. There have been times in the past where there have been manipulations, and generally they haven't worked because the average person I have found usually has a pretty good sense of how he's doing. I mean, if you read the newspaper and the newspaper says, well, the economy was up by 2% last quarter, and it's going along at a good, healthy pace. And if that's your current experience, that's coincident, that's confirmatory both ways. If you ask a person that question and you say, how's the GDP doing? He'll tell you, it's up or whatever it is. But if you ask him, how are you doing? He'll say it's terrible. My business is down. That's where the difference comes in between the consumer sentiment and the headline reporting. In the headline reporting, it can get positive numbers. It will have some positive flow through, but when you get down to the nitty gritty as to how people are feeling, and particularly in terms of elections, the elections will tend to go with the underlying reality. Having a phony boost in the GDP rarely has helped a politician. You get good press with it, but the average guy, if he's not doing well, he'll vote his pocketbook. So it's interesting when you see strong times and then it's confirmed in the polling booth, and strong times when it isn't. We'll see what's going to happen this year. It's going to be a very interesting one.
Absolutely. So, John, as we're talking about GDP, is it possible that we could, just imagine a scenario where we have the same actual GDP year over year, but if we take into account the inflation or the rise in prices, that we end up seeing a positive reflection in the GDP, even though maybe we didn't get an actual, let's say, sales increase, just a price of goods increase?
Well, what you're looking at, when you take the price, if you adjust the nominal sales for inflation, I mean, that's the way it's worked. It's like a guy saying, I was paid $100,000 this year, and that's up from $95,000 last year. But since my cost of living is up by 10%, I'm actually behind where I was. The weighting of all the items that are priced here are weighted accordingly. I mean, it's not just an aggregate number that's used. It's the numbers are aggregated and disaggregated and put back together and disaggregated and put back together again. It is the estimate of the real GDP, which reflects the GDP deflated by effectively the disaggregated components of the GDP, the weightings of the disaggregated nominal GDP deflated by the disaggregated inflation for those components. So it's when you see a real GDP number, that reflects, and there'll be an implicit price deflator, which is the effect of the entire GDP. That's fully consistent in terms of how they estimate it, with the weighting of the product groups and such, both by nominal activity and what they estimate is the inflation. Now, how that GDP deflator works with the CPI, that varies quite a bit. But it's the inflation used for the GDP is consistent with the GDP reporting. The inflation for the CPI is consistent with the estimation of cost of living for consumers. That doesn't mean it's accurate, but at least its preparation is consistent.
Right. So, John, we're talking a lot about this rise that I think the actual person on Main Street ends up seeing in inflation. What do you think the biggest source of that inflation still is at this point? Being, let's say, 4 years removed from the biggest majority of the growth in the money supply that we saw around the lockdowns.
Well, the problem remains the money supply. It's not the money supply is not gone. I mean, right now, if you look at the headline numbers, and what I do in terms of the headline CPI, I'll give you an alternate estimate, which is based on backing out the government's estimates of what they've been doing. And I'm showing headline inflation right now my numbers running about around 8% above what the headline number is. That's for the consumer. And that's a significant difference. And it means that usually when you're seeing reported real growth in income and such of, let's say, 2%, that what the real circumstances is the real growth has shrunk. It's negative. And that's when you tend to get very disgruntled consumers and voters. Mm-hmm. I don't directly estimate that because it's not all, there are a number of angles to pursue on that. But I can tell you that the average person is not thinking that he's seeing whatever they're reporting in the headline income. And then that's not shown in the consumer sentiment. So,
well, when we think about these measures of monetary growth or just money supply in general, we've seen discontinuation of certain series, but what can we use those measures to understand? Can we use, a measure of liquidity to give us clues to different pieces of how the economy might react to them?
Well, when I look at the money supply, let's just go back to the beginning of and we have some real serious problems right now with the money supply. Mm-hmm. If you go back to the beginning of the pandemic, the economy was growing, consumer confidence was positive. The pandemic hit, you had very severe inflation, and that partially was due to very severe flooding of the system with the money supply by the Federal Reserve. And I still look at M3, which used to be the broadest measure of the money supply. Right now, the broadest measure is M2, and they're sort of moving together. So I'm not arguing with anyone over M2 and what it's showing. If you go back to when the pandemic hit and the Fed pumped this tremendous amount of liquidity into the system, they also changed the redefinitions of what was in M2. And if you're looking at the numbers and trying to understand what's happening, it's the most liquid elements of the money supply that are driving the inflation. It's, let's say, cash and checking accounts. That's what people have in hand. That's what they go out and spend on their groceries. That's what drives the consumer economy. They don't liquidate M2 to go out and they don't liquidate a time deposit necessarily to go out and buy a new washing machine. Although they could do that, they'll usually pay for that out of the more liquid and or maybe finance it. You could have long history of the different money supply components going back in time, but when the Fed came in, and put the equivalent of 30 years worth of normal monetary stimulus into the economy when the pandemic hit. 30 years. It just blew everything away on a monetary base and is the basis for the inflation we're still seeing, actual inflation, and for the inflation that we saw back then. Right now, the basic M, when I say they redefined it, M1 used to include number of more liquid elements before we got into the less liquid elements of what is M2. That's now the aggregate money supply. And because they redefined all those elements except for the currency and the time deposits or bank accounts, you don't have a history that you can model. But those alone account for a goodly portion of the money supply. So I've just myself, I call those two elements, the bank accounts and the currency, basic M1, and that is right now. And those who have back in time, those right now show a 57-year peak in liquidity. And I measure the liquidity there as a ratio of those two elements, basically cash, accounts and currency, as a percent of the total money supply M2. They left the money supply M2 definition in place. So if you take effectively the most liquid measure there as a percent of the total money supply, that was at 35% in March, which is the last number they've reported. And although you've been up to that 35% or very close to it a couple of months in the last year, that is actually the highest level. You go to the next decimal point, as again going back 57 years, and it's the liquidity that is driving the inflation. So that the fact that they played around with the other numbers, that's interesting. But where they right now, if you look at what I call the basic money supply, it's up 120% from where it was before the pandemic, or against its pre-pandemic trough. The aggregate money supply, total M2, is up 35%, 35.1% from where it was then. So again, you can see there's been a big shift in the liquidity. The liquidity back then was way below where it is now. So when the Fed says, we're not driving the economy, well, we're not driving the inflation, and we're trying to stimulate economic growth. Yeah, the Fed. You go back to the earlier days, they're saying that the economy was overheating. That the overheating economy was driving the inflation. That was nonsense. There has not been an overheating economy since the pandemic hit. What's been driving the inflation has been the money supply, and that usually works out to explain things than it is right now. Again, 30 years worth of stimulus in the 1 year. Then, now that was all done right after February of 2020 when the pandemic hit, in the February, March. That's when you get the big flood of money supply, and they basically kept up through the year, but that was you had a big lump there. You get to the end of the next year, and you start coming up on March of 2020 is when you see the initial stimulus. You get up to March of 2021. All of a sudden, the year-over-year growth drops off because you're going back year-over-year against what I call the elephant sitting there in the china shop. It dropped sharply. People say, "Oh my goodness, the year-to-year growth dropped off sharply here." Yeah, it did. But the tremendous, 30 years worth of stimulus is still there, and it's still working through the system. And you're still seeing the domestic liquidity. Again, the cash, the checking accounts, what people spend, is at a 57-year peak relative to the other elements of the money supply. So the money supply is still a problem here, and the Fed was never driving the economy. Say never. I'm looking when I say never here. I'm talking about in the post-pandemic period, where the liquidity that they pumped in here has been driving the inflation. They're saying, "Oh my goodness, the economy is overheated, so we're going to raise interest rates." So they raised interest rates, and indeed that's been killing the economy. The economy was positive. I'll contend now that the economy is now, the real underlying economy is negative, and it's been killed partially by the Fed raising the interest rates. They're saying they're raising the interest rates to bring the inflation in line, but it's their money supply that's boosting the inflation, and it's they're raising the rates that's killing the economy, which was never overheating. Now you have another culprit in here, and that's the federal government, and it's got its financing is way out of control. You're seeing a record level of federal debt to the GDP. It is also contributing to the money and inflation problem. So that right now you still have in play record levels of debt and record levels of money supply growth year over year. It hasn't abated. So I don't see any real quick easing coming here with the headline inflation. It's not being driven by the overheating economy. It's not, the goods are general in the broad economy, or where an overheating economy creates inflation, is that too many people are trying to buy a certain product. It's a real strong economy, not enough product there. It effectively tends to build up the prices. It's not that kind of an inflation now. It's all tied to the monetary. The economy is not that strong. The average consumer is not doing that. And to which you can see that in the consumer sentiment. Still 20% shy of recovering where it was at the onset of the pandemic, which was in March of 2020. At that point in time, consumer sentiment was at its highest level in at least 20 years. I think it's longer than that. Basically, the levels last seen back in the 50s. But the consumer sentiment was in good shape coming into the pandemic. It's 20% shy of recovering where it was, and it does not appear ready to recover. What you see, I just refer people to the University of Michigan and their consumer sentiment survey. They discuss what people are looking at, but the problem appears to be perceptions on inflation. I'll let their index speak for itself.
So, John, out of all these, all of these metrics that have been, let's say, misleading, what do you think is the overall actual situation, the realistic situation right now in the US? And where do you think some of the biggest risks lie?
Well, in terms of the economy, even as it's been redefined in the GDP, it's at best flat to minus, probably minus, as most people will feel it. It's going to get a little worse in the next 6 months from what I can see. Again, we're not things that tends to drive the economy, such as consumer liquidity, are not good. The inflation is on the rise despite the gimmicks played with the CPI. I'm looking at a very dangerous time ahead, very dangerous, one where you have conceivably a rising GDP, at least as it'll be reported, but underlying, adjusted for accurate inflation, in downturn. I'll contend the economy is still correcting, and that can get worse. And an actual inflation that is beginning to approach something close to a very high inflation, even potentially a hyperinflation. From a practical standpoint, from what the average guy's going to be seeing, is be a weaker economy and higher inflation with no immediate relief, and perhaps a very bad inflation. That, I think, increasingly will become the common view. That's not good for the politicians, whoever's in power. It's not easily fixed. The deficit is beyond control, and the government's doing what it can to spend there. The Fed's doing everything it can to keep the system afloat. I mean, I think there's some risk here of a hyperinflationary depression. In times like that, particularly when you see, the best bets I can give you here are that the economy is going to be worse a year from now than it is today, and inflation is going to be worse. It's just a matter of the order of magnitudes. And best way to hedge against that, at least from the inflation standpoint, is holding precious metals such as physical gold coins, not numismatically valued coins, but coins that someone sees that says, yeah, that's a gold piece. Mm-hmm. So you don't have to assay it. Same thing with silver coins. The precious metals over time have held their value against circumstances like this, particularly the very bad inflation, which is already with us. although not fully reported yet, you're going to see that increasingly being reported. That'll preserve the purchasing power of your assets. Your house, you own your house free and clear. Real estate, the term real means that's a hard asset. It's not as liquid as gold and silver, but it will retain its value. Stocks and bonds, depending upon the nature of the background, generally you're looking at a weaker economy and higher interest rates, which in terms of current prices would mean lower stock prices and lower bond prices with a higher inflation. So I guess you could say I'm basically urging people to at least have some store of the traditional physical assets such as gold and silver that will tend to preserve your purchasing power. It's just as what you can be comfortable with, and just be real careful with the rest of it because you've got some very difficult times ahead of you.
John, do you think that gold has done a good job of really being an inflation hedge over, let's say, the last 40 years?
Well, it's had its ups and downs, and it's because of its nature as backing for some central bank currencies. It gets heavily manipulated. We've seen that in recent years, but we're beginning to see it break free from that. Over time, it has. I mean, I've known people who have lived through different times. We're not quite to the point yet in the United States where it's made too big of a difference, but it's a lot. You're seeing record gold prices now, which is a sign of what's happening. But I can remember the stories of people who've lived through hyperinflationary times. The people I've known who used to have some business dealings with Germany, and knew people who lived through the terrible times they had at the late 20s and 30s. One fellow whose father was the export manager of a company that I had some dealings with told me how his father had one day traded, and at the peak of the crisis, had traded his shirt for a can of sardines. So they'd have some dinner that night, and they opened the can of sardines. Unfortunately, the can of sardines had gone bad.
Jeez. Gold
coins, silver coins, however you hold them, but I'd have to certainly take physical possession or have easy access to them, will tend to protect you in difficult times. And I think we have the potential. It's not upon us right now, but as the economy starts blowing apart and the inflation starts blowing apart, you could have people trading shirts for sardines. If you have some silver coins or gold coins, you're going to be in a lot better shape.
Mm-hmm. John, one last question for you. Do you think that, if we go into this period of, let's say, major instability, that the Fed is going to do what they have always done and just come back both guns blazing, cut rates, and come back with QE, despite the effect that it's pretty apparent that it has had on inflation and the economy?
Probably. That'll be their argument. The QE will add to the inflationary pressures. It's, again, the inflation here is from the monetary, and it is not from an overheating economy. And the whatever financial stimulus in terms of the liquidity put into the system, it has not done that much to help the economy other than keep the banks liquid. You have to keep in mind that the Federal Reserve is the central bank. It is owned by the banking system, by the banks, and so its primary function is to keep the domestic banking system afloat. And that's what it's doing. Mm-hmm. And to go in at a time when the economy was falling apart and saying that after they pumped all this money in to say that the economy was overheating and was driving the inflation, they had to raise interest rates. That's absurd. It's absurd on its face. Mm-hmm. It was an excuse for raising the interest rates because the banks needed higher interest rates, or at least they wanted to get there. Banks had their profits set with the low interest rates, and someone had been shifting around. They'll do better with the higher interest rates as they get things stabilized. It's very costly, of course, for the economy and the American public, and indeed it's hurting the economy. But even though the economy is being hurt, it's not bringing down the inflation because it's not the economy that's driving the inflation. It's the tremendous expansion of the money supply and the monetary base and the federal debt and deficit right now that are exploding without containment. Mm-hmm. It's a circumstance we have not seen. I mean, there have been bad times, but nothing like this. It's the type of thing that can lead to the hyperinflation.
Mm-hmm. Nothing with a debt to GDP ratio in this stratospheric zone without really the ability to have an effect on one side of the scale or the other from a stimulus standpoint, right?
Yeah. It's an extraordinary time, and we're already into the period where they're trying to keep things afloat. And it's, as you're pointing out, you're seeing times here that are not normal. You got the purpose of the central banks is to keep afloat, keep the monetary system flowing, and I mean, if that collapses, you have a real economic implosion. But the other end, which is what is being pushed, is also what gives you the hyperinflation, and that's they're not having a real good time in getting things balanced out. Very difficult, and it's not the efforts made to try and help the consumer are contrary to what they need to try and get the banks back in balance. So what's being pushed here is in the interest of the banks more than it is the interest of the consumer.
Do you think that we have begun to experience or gone through this period where the lags of the interest rate, the ratcheting up of the interest rate, have taken effect in the economy, John?
The economy's collapsed in many ways. Mm-hmm. I mean, raising interest rates here, we're already seeing the impact of negative interest rates. We have, I mean, that's been a factor behind softening economic activity here. You have no growth in the basic underlying economy year over year, despite the headline numbers. Happy headline numbers that show 3% growth in the GDP. The gross domestic income, which is a theoretical equivalent of the gross domestic product. The two of them, one's calculated from the income side, the other's calculated from the economic side. What you're saying is those two numbers should be equal, and where the GDP is up 3% year over year, the last three quarters. The last 3 quarters of reporting, we only have 2 quarters of reporting on the GDI, but the GDI going back of the first quarter against the first quarter reporting here in this, I'm talking three-quarter GDP cycle that's been reported. The GDP is up 3% year over year, zero growth in the gross domestic income. That's the greatest differential ever seen between those two series. And since they've been calculated going back to 1949 or such. The next quarter, which was the fourth quarter of last year, you had the 3% GDP growth. The GDI did increase, and it was 1.4%, but that's still an extraordinary discrepancy, the one that's not normally seen. Again, those two numbers are supposed to be measuring the equivalent sides of the same measure, and that's overall economy. Now we have an initial estimate on the third quarter GDP that's up at, again, 3% year over year. But in this whole period of time, the basic economic numbers such as retail sales, industrial production, housing, employment, you're not seeing the growth there that you normally see with those. So I'm number one, I think the GDI is the more accurate measure, but with the last time you saw anything like that in terms of the discrepancy between the gross domestic product and the gross domestic income was at the onset of the Great Recession. Mm-hmm. And I mentioned the Great Recession. We're seeing patterns there in the employment that are suggestive of that as well. It's a very, very dangerous circumstance. Mm-hmm. I would not be saying it may be hip or very wonderful if the economy is growing at 3%, but if you saw, you have to have the confirming numbers behind that to be comfortable that you're really seeing that. And my contention is that we're in a circumstance right now where the economy is weaker and dropping, and the inflation is stronger and rising than is being headlined, and that's heading us to something like a Great Recession, depression.
Well, John, I really appreciate you giving us your input and your perspective on all of these different issues, metrics, and what they all mean today. For those that want to learn more about John's work, it's all available at shadowgovernmentstats.com. And there you provide a more in-depth look at many of these metrics and more of an explanation on what they all mean, right?
I do, but I have one thing that's very important. If you want, you can contact me directly, John Williams at shadowstats.com. The website collapsed back in August. We were with one host for 20 years, had a good relationship with them, and they went out of business with little notice back in August. And when they did, I found that our site which was working very well, had antiquated programming and didn't work too well on the new sites. So I've left the site is there. It gives you the background on all that we do. But if you want the latest outlook, I'd be happy to provide it to you. And numbers or to communicate with me, just to please send me an email at John Williams at shadowstats.com. I'll get back to you. You try and there may be a link there on the old site, but you can't get the latest material from there. It's there for background information. There's a 20-year history archives there if you want to look at that.
Yeah, and your email is on the website as well at shadowstats.com. And we can put that in the show notes as well. And maybe if any of our listeners can help John recover that website, maybe reach out as well. That would be, I think, really helpful, right?
Appreciate any help.
Excellent. John, thanks so much for your time today. Really appreciate it.
Thank you, sir. I greatly appreciate your time.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.